sort of a lot of questions about assignments. Karina, are you allowed to print some pages from the textbook while taking this course? Yes. So you can print any pages that you want. Okay. So let's do Chapter 7. Take all of your stress about the assignment, put it to one side, because I know you're worrying about it. Let's focus on learning the information we need to be able to do the assignment. So let's do that first. Okay. I'm going to share my screen. And again, we're going to go fairly quickly through some things that are, it's a line, put it on the form. Here's a line, put it on the form, because you can do that on your own. I'm going to spend a little bit more time on some of the things that are theory-based that are difficult to understand, and we will be doing calculations. So make sure you have a calculator or some calculating device available, because participation is going to give you the practice that you need to be really confident in this unit. We're doing investment income today. It is one of my favorite chapters. There's a lot of really neat stuff in here. You're going to feel like there's 6 million new forms, but the nice thing is it's all very organized. So it's the slips will tell you where to put things. The forms will be fairly straightforward. And it's really just a question of starting to understand some different types of income that we have when you're not working to earn the money, when the money is earning money for you. So we're going to do dividends. We're going to talk about interest, briefly about foreign investment income. That's going to be brief only because most of it you already know from doing Chapter 2, T1135s. We're going to talk about capital gains, specifically the ones that are reported on tax slips. We're not going to cover all capital gains in this course. There are actually 2 more advanced courses just for dealing with capital gains on a tax return. We have a Capital Gains 1 and a Capital Gains 2 course. That's beyond what we're going to do. But you will definitely be seeing capital gains reported on tax slips as a new associate doing regular returns. So we'll teach you that. We're going to talk about principal residence. I'm going to spend some time on that because it's a very expensive thing to get wrong on a tax return for your client. So we'll dig in on that a little bit. Attribution rules we're going to talk about quite a bit, and then we'll do carrying charges and interest expenses at the end. Okay, I'm going to skip through this because we don't have time to talk about what we're going to do. We're just going to do it. I want to start with the federal worksheet. So we've been using the federal worksheet up till now to calculate credits, but sometimes it also helps to organize and calculate our income. So when we're dealing with investment income and dividend income, most of that income, not all, but most of that income is found on the federal worksheet. If you've been doing tax returns for a few years, you might be frustrated because they keep changing this sheet. So when I started doing tax, this section was called a Schedule 1, and it had a certain number of lines on it. Then they stopped having a Schedule 1. You'll notice there is no Schedule 1, and they just added it to the worksheet. In 2021, they've actually given it more of a breakdown because they're trying to capture more information about what type of investment income people have. So we now have a slightly more complicated form with more spots to put information, but the way the form works is the same. We start with dividends, and there's 2 different types of dividends we're going to talk about. There's eligible and other than eligible. Then we have a section to deal with interest and all other investment income that doesn't go anywhere else on the return. And you're going to see we now have categories in that section, which is nice because you can find the right line and put it in there. And then at the very end, we talk about carrying charges and interest expenses. Those are deductions on the tax return that are related to investments. And then we have one more thing that's not on the federal worksheet, which is the federal dividend tax credit. That goes in the non-refundable credit section of the tax return. So when we're dealing with income, we're going to have lots of things to think about. But again, you're going to use your forms to help you be organized so that you know where everything goes. Let's talk about dividends first. How do you get dividends? What do you have to do to get a dividend? We'll have people in this class. Some people will have lots of investment and finance knowledge, and some people will have not a lot. If you own shares, it's like owning a piece of a company. So I now own part of that company. I'm not going to make day-to-day decisions for the company, but if the company makes a profit and they want to share that profit with me, they will issue me a dividend. Some companies issue dividends on a regular basis. They are required to pay dividends at a certain number of times every year. Some companies only do them when they have a profit that they want to share. Your clients who have investments will try to invest in things that pay dividends because it's really nice to get money regularly without having to sell your shares in order to cash in and get that money. There are two different types of corporations that we have in Canada, and right now I'm only going to talk about dividends that come from Canadian corporations because they have special rules on the tax return. We have large companies who will issue something called an eligible dividend. And then we have small Canadian companies. Usually these are privately held Canadian companies with smaller amounts of income and smaller amounts of assets. If they qualify for the small business deduction as a corporation, they will issue something called an other than eligible dividend. So there's eligible and other than eligible dividends. What you need to know about dividends is dividends are taxed in the corporation, and then when they pay the money out to the person who receives it, to the shareholder, they get taxed again. And because they don't want to have a double taxation situation, we have to do this kind of adjustment to come up with the right amount so that at the end of the day, hopefully the right amount of tax is paid by everyone. We probably have the sense in Canada that corporations generally pay tax at a lower rate than individuals do, so they pay a fairly low tax rate. So what we do with dividends is when you get issued a dividend, you will receive an actual amount of money. On the tax return, we have to increase that. We do what's called a gross up. We add more to it, and we say the $100 dividend you got is actually worth $138 if it's eligible dividends, or $115 if it's other than eligible. We then tax you on that amount, and then because the corporation has already paid some tax, we give you a dividend tax credit to compensate for that. It seems really complicated. What I will tell you is most of the time, you don't need to do this calculation. It's going to happen on a tax slip. That being said, it is possible that you'll have a client who owns shares where they're not receiving a tax slip. So again, especially some of these small companies, you may have a client who has shares in a small family business, that kind of thing, where they could be issued a dividend and no tax slip is actually given to them, in which case you would theoretically have to do the calculating yourself. So we have two different types of what are called gross ups and then a dividend tax credit. Eligible dividends, you gross up at a higher tax rate. So you gross up at 38%, and then you get a bigger dividend tax credit. Other than eligible dividends, because of the small business exemption, you only gross up at 15%, and then you get a slightly lower dividend tax credit. Keep an eye on these numbers. I'm going to come back to them again because we're going to practice doing this. And Brittany says, why, from what you've seen, the tax credit isn't even half of the extra they're making you report? It really is a very complicated way. You have to know a lot of details about corporate tax returns. They have different types of tax, and then credits go in different ways. So all you're going to know is that corporate tax is very complicated, and when you take money out of the corporation in the form of a dividend, this is how we deal with it. It does, when you know all the little intricate details and pieces, work out to functionally the same amount of tax has been paid that should be paid. What you'll find is dividends are actually one of the best ways to get money on a tax return and pay the least tax. So compared to the other type of investment income, like interest income where we pay 100% tax on it, dividends are a very valuable way to get money and not pay full tax on it. And Leon, is the company payment of the dividend corporation tax? Yes, so the company will pay corporation tax, and they pay tax before they issue dividends. So dividends are after tax dollars for companies. You don't need to know that for this course. I just know some people like to know how all this works and why we're doing it. So that is why we're doing it. Okay. And Coolwinder, if the client is reinvesting the dividends, you still have to report it. Yes, because if you get a dividend and you use that dividend to buy more things, you still have more stuff than you had before, and the stuff that you had has value, and so you will get, in that case, information about the value of those dividends, which you'll do the gross up and calculate the dividend tax credit for, or more likely will just be reported on a slip for you. Okay. So we're going to practice this a little bit if you have a calculator. Now, I want to make sure that you have those rates. So I think what I'm going to do, just to make life simple for everyone, is I'm going to type in the chat window, so you have it. Eligible, you have a gross up of 38% and a 15.0198% dividend tax credit. And then other, you have 15% gross up and you have 9.0301% dividend tax credit. Do the gross up first. The dividend tax credit is based on the gross up. Okay, so let's test one. If I have an eligible dividend, what will the taxable amount, that's the part that's going to go on the tax return, what will the taxable amount be? And what will the federal dividend credit be? Get some answers in our chat window here. Can I get a brave volunteer to stick their neck out and give the first one a try? So we're going to do eligible, 138. Federal tax credit, 20.73 if you round up, I think. Okay. And Brittany, even with math errors, it's good to practice. Not all people know this. I'm actually dyslexic, so I have to do all my math 3 times. If I get a different answer all 3 times, I have to do it 5 times. All right. So this one is an eligible dividend. That means it's coming from a large Canadian corporation. What line number will we put the taxable amount on the federal worksheet? On line 12000. Excellent. All right, let's try the next one. We have an other than eligible dividend of $100. So if you have to, you can scroll back up to find those rates. We've got other than eligible is 15%. Federal credit 9.0301. Okay, I'm seeing a couple of people saying $115 and 10.38. You are correct. What 2 line numbers on the federal worksheet will that be on? And I think just for fun, I'm going to pull up a federal worksheet now so we have one to look at. I realized that I did not open. Oh, I did open a window, so I'll put it on here. I'm going to open up a federal worksheet. Okay, it's going to go in 2 places, and you've got it right. It's 1200 and 12010. Okay, and that's important because what happens when people do this form, and I don't know why this happens except of the way that it's formatted, if you have other than eligible dividends, you put it on line 5, and then you enter it on line 12010. And what everybody forgets to do when they get to the bottom and they actually see what goes on the return is they forget to add all the boxes together. So make sure when you do this form that you don't just put it on the reporting line, which is 12010, you also put it on the income line of the return, which is 12000. Does that make sense? So we separate it out, other than eligible first, taxable next, and then they actually now have a place to do the calculating for you. If you did not receive a tax slip, you can enter it here, and that will go into the right places. Okay? Excellent. Good, let's do the next one. This is, I'm going to warn you, a trick question. So if you have 100,000 US, what is the taxable amount and what is the federal credit? Let's see who really, really, really knows their stuff. I expect most people to get this one wrong, and if you do, that's okay. That's how we learn. So remember, we have to put things on the return in Canadian funds. What is the exchange rate? It is 1.2535. So what is the value? And Connie says it may not be claimed. Well, it has to be reported as income, so we have a taxable amount. What is the taxable amount? The taxable amount, we don't need to worry about a gross up because it wasn't taxed in Canada, but it has to be taxed in Canada now. So the taxable amount will be the conversion from US to Canadian. Will there be a federal credit for the tax already paid? No, because no tax was paid to the Canadian government. So you're not going to get a dividend tax credit for it. You are, however, going to have to report the dividend in Canadian dollars. So that was the tricky one. If it's not a Canadian dividend, do not do the gross up, do not give them a tax credit, but do make sure you're reporting it in Canadian dollars. And just to be extra sneaky, what line number are we going to put foreign income on the federal worksheet? It's a foreign dividend. Where do foreign dividends go? On the federal worksheet, and then on the tax return, what line number are we looking for? Line number 6 on the worksheet in part 2, and it goes on line 12100. That's the trick. I told you it was a trick question ahead of time. We get into the habit when we're doing this part of it of grossing up every dividend we see. We're only doing this calculation for Canadian dividends because only Canadian dividends have already had some tax paid in Canada. Okay, good. We did the easy ones. Let's do a few more. We have eligible dividends, 250. What does that work out to for a taxable amount? Gross it up first, and then take the tax credit. If you're not quick at math, then you can jump ahead and do the next one ahead of time. All right, we've got 354 and 5181. Let's see. 5182. Watch those rounding numbers. They will bite you in places you don't want to be bitten when you're doing assignments. Make sure you're rounding correctly. Okay, 5182, very good. Let's try the next one. Other than eligible $375, what do we get? Okay, I see a 431.25, and I want a dividend tax credit. Dividend tax credit should be $38.94 with the rounding. In this case, we're not going to round up because the decimal after it is a 2. Okay, I'm not going to do all of these right now because I have more things that I want to do with you. You are going to have this slide in your PowerPoint slides at the end of today's class. What you can do if you want more practice, I'll give you the rest of the answers in a minute, is just cover up the right side of the page and practice your calculating. Okay? And again, most of the time, this would already be reported in a slip, but some of the time it isn't. And if it's not, and your client received a dividend from a Canadian corporation, you have to determine by asking them, was it an eligible dividend or other than eligible dividend? The corporation will tell you. And then you have to ask them, how much did you get? And you will do the gross up and you will do the credit. Don't forget to put the credit on the return because it is a non-refundable credit. If you don't ask for it, the government doesn't have to give it to you. You'll notice when you do this, on the federal side that you're going to have a similar calculation on the provincial side. So if you're doing dividend credits, you're going to calculate the dividend credits, or you're going to get them from the tax return. And when you get to the Manitoba form, you're going to see on the Manitoba form that you have a different adjustment based on provincial tax rates. And Karina, do I meet a lot of cases with foreign dividends in real life? Foreign dividends are very common. Lots of people have investments outside of the country. Canadian dividends that are not reported on a slip is much less common. So that we're not going to see all that often, but it is important to know kind of what's happening here. Okay. You feel like it should be refundable because what they're making you report is more than you actually got. It seems unnecessarily complicated. Corporate tax in Canada is unnecessarily complicated, but that is kind of how they manage to give corporations really big tax breaks. And people who have corporations have lots of options to try to not pay tax for as long as possible. So if we wanted to make this simple, we would make everyone who owns a corporation mad, because making it simple would mean just tax everything at regular rates. So yes, it is complicated. What you have to remember is whatever the client got is not the number we need. We need the taxable amount. Again, on a slip, and I think we're going to come to this next, when you see a tax slip, most of the time you're going to see that it'll tell you the actual amount, the taxable amount, and the dividend credit. Remember that what goes on the return is the taxable amount from the Canadian corporation, not the actual. All right, so we have now looked at the top part, which is dividends from Canadian corporations on our federal worksheet. And then, of course, we're going to take that number and we're going to put it on the correct line, either 12000 of the tax return, unless it's a foreign dividend, and then it goes on line 100 of the tax return. Okay. Don't forget the reporting line. The reporting line for other than eligible dividends matters because it changes what happens on the provincial side. You get taxed at a lower rate. You get a different provincial dividend credit. So we have to make sure that other than eligible goes on 12010. All dividends go on 12000. Beautiful summation. Thank you for that, Helene. Okay, where does the federal dividend tax credit go? It goes on a 4 number because it is a non-refundable credit. So after you've calculated your regular non-refundable credits, you will see that there is a place for a dividend tax credit on line 40425 of the return. And again, in previous years, they just said put it on the return. Now we have a worksheet that helps us do the breakdown. If it's from a slip, you add it all together. If it's not on a slip, it shows you how to do the calculation there. Okay, it shouldn't be common for you to do the calculations. I get it a little more often only because I do corporate returns as well. So I'm helping the people doing the corporate returns to also prepare their tax slips and their dividend slips and the documentation for that. So I do this when I have to do it, but you will probably not be doing these calculations. You do need to understand why you're putting a larger number on the tax return than what the client actually got. So that you do have to be able to explain. Okay, what we normally see, well, there's lots of different slips that will have dividend income on them. Commonly, we see T5s and T3s. Again, I'm going to stress, do not start memorizing box numbers. You're going to go crazy because the box numbers for all the slips are different and they all go in the same place. If you read the box, it tells you what it is. So eligible dividends on a T5 are box 24, taxable is 25, and dividend tax credit is 26. We're going to do a quick annotation here just to see if you've been paying attention. I would like you to, on this page, circle for me what goes on the tax return. So out of the 6 box numbers on here, what needs to end up on the tax return? Let's see what you think. Box 25 taxable dividends does. Box 26 dividend tax credit does. Very good. Box 11 taxable dividends and box 12 dividend tax credit. If you've got that, You have the right idea. You're going to put them on the worksheet first, and when you finish your whole worksheet, you're going to put them on the tax return. Excellent. Good. Oh, I skipped one and I didn't want to. We have dividends. You could find dividends on a T4PS slip, which is a profit sharing slip. If they're there, you're going to have 6 boxes again, box 30, 31, and 32 for eligible, box 24, 25, 26 for other than eligible. Again, you don't need the actual amount. You just need the taxable and dividend credit. Put it on the worksheet first. When the worksheet is finished, put it on the tax return. Easy. Don't memorize the box numbers because I'm going to change them on the next slip. Here we go. What is the next slip? On a T3, box 49, 50, 51, and 23. 32 and 39, don't ask me why they're not in order. There's probably a reason for that. Don't try to memorize them. The boxes themselves are very clear. They say other than eligible, actual taxable dividend, and eligible actual taxable dividend. Just read the slip. So in this case, box 50, 51, 32, and 39 will end up on your worksheet and then ultimately on your tax return. Okay. See, good, that's dividends. Are there any questions about dividends? So you know that you get them because you own an asset. And as long as you own the asset and that company has profits that they want to share with you, you will receive income. That income goes on the tax return on a federal worksheet first. If it's Canadian, you're going to be in the top part of the worksheet. If it's foreign dividends, you're going to be on the bottom part of the worksheet. Fill out the worksheet and put it on the return. The gross up and everything only matters if you're calculating it yourself. Okay, we have another type of income that comes as a result of owning part of a company. And some provinces will spend a lot less time on this page than I will. It's called patronage allocations. This is what happens if you are a member of a co-op. Can anyone name for me some of the co-ops that we really commonly see in Manitoba? A lot of our clients have these slips. Red River's the big one. Red River Co-op. There are a couple of gas co-ops. So these are places where in order to shop at the store or to get the services of the store, you actually have to become an owner. You have to buy into the company a little bit. And then what happens is you get the benefit and you get a discount. What you'll get from that is what's called a T4A slip, a box 30. It's patronage allocations. All you need to know about that is you have a number on that slip in box 30. You have to decide if it's taxable or not taxable. Okay? If you have a client who is self-employed, they might be using that co-op in order to do things for their business. In that case, it would be taxable. So people who are using the co-op for business purposes will have to put that on line 13000. Everybody else, everyone who's using it just for personal use, it's not taxable. So what I want you to know is when you get this in real life, you're going to download the tax slip using your autofill my return, and it's going to fill in a T4A slip and a box 30, and it's going to show up on line 13000. You're going to look at that and go, oh, that's for personal use. It's not taxable, and you're going to take it off line 13000. Okay? Only people who are doing self-employed business returns or corporate business returns have to worry about anything else, and you're not doing those returns. So when you see this, and you will, I don't think there's ever been an office that hasn't seen at least one of these slips. Make sure when you download the slip that you know that it's not taxable and you take it off line 13000 because that's where the computer's going to put it. Any questions about that? Elaine, why fill in the T4A in the tax form? When we do an autofill my return, it downloads everything. So we have to put it in because the slip exists, but we have to let them know that it's not there. So this is one of those things where if you're using autofill my return as a data entry service, you end up with the wrong information on the tax return. This is one of those things we have to watch out for in an office. And again, it's about knowing it, because the slip exists. It is taxable for some people. We have to make the judgment call, is it taxable for our client? For this course, it will not be taxable for your client. And yes, we do autofill at the office all the time. That being said, it depends on when the slips are available. So tax slips have to be filed by businesses by the end of February. They have until the last day of February to file them. So if people are coming in to do their tax returns in early February, or even sometimes in the first week of March, those slips have not been posted yet. So we actually do quite a bit of manual data entry of tax slips at the beginning of the tax season. And then towards the end of the tax season, it's a lot more downloading and making decisions after we do the download. Okay. There is a special rule for dividends that your spouse owns. I'm going to mention it today, and then you're going to all forget it because you're going to be very busy. And by the time we get to spouses, I'm going to ask you if you remembered it, and you're all going to go, what rule? Okay, so please try to remember that this rule exists. It will make more sense when I teach you about spousal credits. Okay, so at some point in the future, I'm going to explain to you that spouses who have low income, who you are financially supporting, you can claim a tax credit for those spouses. The tax credit is called a spousal amount, a spouse or common law partner amount. For dividend income, there is a special rule, and it is an option. You have a choice to do it. If your spouse is someone who is low enough income and they have dividends, you can choose to report all of their dividend income, which includes their dividend tax credit, so all of their dividends as your income on the return, if doing that means you get more of a spousal credit, or if it means if you weren't getting a spousal credit, but because you've moved that income over to your spouse, now you're going to get a spousal credit, then you can do that. Okay. It seems counterintuitive, because why do we want the higher income person to have more income? But remember, dividends have a dividend tax credit attached to it, and that dividend tax credit is actually a pretty valuable one. And the spousal amount is another tax credit. So we give them the dividend tax credit and we give them the spousal amount in this case, or part of the spousal amount. Altogether, it's usually better to move the income onto the higher income earner. But it is an election. If you're going to do it, you have to transfer all. You can't just transfer some of the dividends and keep some on the other spouse. It's all or nothing. You're not going to see a lot of it until I teach you about spouses, but when I teach you about spouses, I'm going to ask if you remember the special rule about dividends, and we'll see who remembers it. Are there any questions about that? And Helene, I do see your question. I'll answer that one in just a moment. So the dividends reported by spouse, if your spouse is low income and has dividend income, you can elect to have all of the dividend income put on the higher income spouse's return, give them the dividend credit, and let them claim a larger or some spousal amount, which I'll teach you about later. All right, so Helene, for autofill, the client doesn't have to have my account for you to have autofill. So if you have represent a client, you can do autofill my account and you can access everything the CRA has for them, even if they haven't set up my account. So we do it for all of our clients. It is the best way to find missing slips. There are a lot of people who, especially people who don't want to do their own taxes, and that's why they're coming to see us. They'll come in with 2 tax slips and they'll go, I think this is everything. And you'll go do a download and you'll get 5 more. So that happens all the time. So we do autofill for all of our clients. Okay. So we've done one type of investment income, which is dividends. I'm going to do another type of investment income next, which you already know a little bit about. It's interest. Okay. If you earn interest in Canada or anywhere else in the world, but you're a resident in Canada, you have to put it on your tax return. Not all interest is reported on a slip. So Banks generally will report interest on a slip if the interest is $50 or more. They don't have to. That's just their general practice. You are required to report interest, however, even if it's like 25 cents of interest, technically. Now, from a realistic standpoint, are we making every single client go back to their bank statements and tell us about the $2 of interest they had on their account? Probably not. But we should be keeping an eye out for it, because if it is enough interest to affect the tax return in any noticeable way, they are required to report it. And if you know they have interest from other countries, they are required to report that as well. So we should be asking, what kind of income do you have from interest? Do you have a lot of interest from your bank accounts? Where are your bank accounts? Are they all in the country? And make sure we're not missing some income just because they don't have a tax slip for it. Okay. All of this goes in the same line, whether it's Canadian or foreign. Any investment income. So most investment income is interest, but not all. Any foreign investment income, any Canadian investment income, any interest that you get will be reported on line 12100 of the tax return, whether it is on a tax slip or not on a tax slip. Okay. You can also get interest from the CRA. How do you get interest from the CRA? Do you know? When will the CRA pay interest to taxpayers? If you filed your return on time or within a reasonable time, and the CRA took an unusually long time to process your return, they have held on to your refund because they were processing your return. They will give you interest from the date that you filed it to when they processed it. So they do issue interest on refunds if the reason for the delay was them. Now, if you had a refund from 8 years ago and you just never filed that return, if you file that return and they process it in a reasonable enough time, you're not going to get interest on that because it's your fault for being 8 years late. But if it takes them 10 months to process that return, you will get 10 months of interest. So you can get interest from a CRA. Interest is taxable. It has to go on the return. If you don't put it on the return, obviously you're going to get in trouble. The CRA knew about it. They're the ones who gave you the interest. So my question for you is, how do you know if the taxpayer who's sitting in front of you had CRA interest? Where can you get that information from? On the notice of assessment. The notice of assessment will, in a paragraph somewhere in the middle of it, say, and you received CRA interest. Good. If your client did not bring their notice of assessment to you, you should go find it. So you can get it through Represent a Client. You can look at their notice of assessment. You should be checking them to see if there's CRA interest because, again, you might forget to put it on the return, but the CRA knows that it should be on the return. They're going to go looking for it, and you can get dinged for not reporting all your income. So make sure you're asking about interest, not just interest on slips, but interest that is not on slips. Go looking for it. And again, I want to show you, in case you've been doing this before, but it looks different now, we have more of a breakdown. So if you have a box 25, you have interest on a T3 slip, it'll go here. T5 will be box 13, 14, 15, and 30 will go here. T5013, we're not going to do that in this course, but if you get one and you have those boxes, it'll go here. Interest on a tax refund, that's the CRA interest, now goes on line 5. Income from foreign sources, convert to Canadian dollars, goes on line 6. Interest from bank accounts that's not on a slip. Anything not on a slip, bank accounts, guaranteed income certificates, guaranteed investment certificates, treasury bills, life insurance policy, interest, anything you receive has to be there. Those ones are tricky. GICs, usually they're set terms. You might have a 5-year GIC. You're not going to get the money until the end of the term, but you have to report the interest every year. It has to be reported annually. So even though you haven't received the money yet, it has to go on your tax return as being earned in the year. Most of the time, that will be on a slip of some kind. And I would say probably you're not going to see too much of that, but if you do know your client has a GIC and you don't have a tax slip showing interest on it, you should be asking about that one, or getting a senior associate if there's an investment that your client has that you're not very comfortable with. Royalties, you may have missed this in Chapter 2, but I'm going to bring you all back to Chapter 2 very briefly, and we're going to talk about royalty income. There was a lot in Chapter 2, so we couldn't look at absolutely everything. But if I'm looking at other employment income and I go way, way, way down to the bottom, we have a thing about royalties down there. Royalties from a work or invention, what are the rules for it? If you produced or invented something yourself, then you will get royalties on that. So, if, for example, you might have composed a piece, you might have invented a pen that writes upside down without being affected by gravity. Who knows what it is? If you have a work or an invention and you get royalty income from it, you have to enter that on line 10400. That is other employment income. On the other hand, you can also get royalties for something that you invested in. I gave money to someone and told them to use it to invent something. If it's from an investment, in that case, the royalty income is going to go here on line 12100 and on the federal worksheet. So bringing your attention to that, I want you to notice royalties and works can go in two places. If I created it, if I invented it, it's going to go on line 10400. If I just invested in something that somebody else invented or created, it's going to go on the federal worksheet, and it's going to go as interest or other investment income. Okay. A couple more rules about interest. It must be reported when it is earned, regardless of when it is received. Again, that is particularly important when we're talking about GICs, because you may have a locked-in period where you can't take your money out for 5 years, but it's earning interest every year. You have to report the interest every year. The really tricky one, and the one that people are going to miss, interest in a joint account must be reported in proportion to who put the money in. So when you have a joint account, sometimes the tax slip will have both names on it. Sometimes the tax slip will only have one name, the primary holder of the account. You can't trust the name on the tax slip as the place where the money is going to be reported. You have to ask the client whenever you see something that could be a joint account, is this a joint account? And if they say yes, you're going to say, who else holds the account with you? They'll tell you that, and then you have to say, what portion did you put money into the account compared to them? If it's spouses, they might have put it in 50-50. They might both equally contribute to that account, but they might not. It might be that one spouse puts all the money into a joint account and they both take money out of the account. In that case, you have to report it based on who put the money in. And Brittany, what if they don't know? They can find out. They can go to their bank and see where the money went in. Most people have a sense. And again, we can only do the best we can do. If it's roughly 50-50, if they both contribute semi-equally, then that's fine. But if one person significantly contributes and the other person doesn't, we have to make sure that's reflected in the income. Think about it this way. If we go back to sort of the old stereotype of a married couple, you'll have a stay-at-home mom and a working dad, and the dad will make lots of money and have a lot of income, and the mom will have no income at all because she's at home with the kids doing very valuable work. Okay? If he takes the money that he earns and he puts it in an account that is a joint account, and he puts all that money in the account and it gets taxed 50-50, then half of that money is being taxed at too low a rate. He would want to do that. He would want to say all of it is her money. He would want to put in an account just in her name and then say, oh, but I don't have to pay interest at a high tax rate for that because it's her income. Her name's on the account. So there's a rule that says you can't do that. We're going to get into the nitty-gritty of that rule in the attribution rules, but it applies to joint accounts as well. You have to report the income in proportion to who put the money in. So how to do that? There are some really good illustrations in the book. Again, most clients have a rough idea of how much is going into an account. They'll know who makes more money. They'll know roughly the split of what's going into that account. Ask them. Any T3 slip, any T5 slip you get, ask, is it a joint account? If it's a joint account, how many people is it a joint account with? Roughly who puts the money in, so that you can report it correctly. Okay? And then interest that's not on a slip, remember that has to be reported on the return. If you know they have interest, it has to be reported on the return. One clue to that is if you have a client who normally has a slip with interest on it, and this year they don't have one, and that interest was always a little bit more than $50, probably the markets were worse this year, so they didn't get a slip this year, but they probably still had, let's say, $45 of interest instead of $50. Go have them check with their bank and get the amount of interest and put it on. If you notice a pattern of having income in previous years and they don't have that income this year, ask them why they don't have it. They might have a good answer. I had a client where they always had interest income, and then the next year they didn't, and I said, what happened? And they went, oh, well, we had this really big renovation. We took all of our money out of our bank account, and that's why we didn't get any interest this year. All right, you closed your account down, you're not going to get interest anymore. That makes sense why I'm not claiming interest this year. On the other hand, maybe that account is still active and they should be reporting their interest. We need to go find it. Are there any questions about the interest side of things? Okay, I think I'm going to take a quick break there. We're going to come back. We're going to delve into a little bit of an activity just to test it. So I think we'll take a break to just solidify all of that. We're going to jump into a little bit more testing what we know about interest and slips. And then we still have to do principal residence and attribution rules, and then one more review problem. So let's just take a 5-minute break. We're going to come back right at 11. All right, we are back from break. Give me a check mark if you're back. You can give me a smiley face if you want to let me know how you're doing. All right, feeling pretty confident. I like to see that. I really do enjoy this because there are so many interesting things we can do with investments. So we're going to keep going, and we're going to test your knowledge just a little bit with an activity. So I have Beverly here. Beverly has a bank account that she uses for her day-to-day needs. She's a widow, and her health is not what it used to be. Her daughter, Carla, convinces her to convert her account to a joint account so that she can help with bill payments and other financial activities. Carla puts $1,000 into the account each month to help cover some costs for her mother. And then in March, the bank issues a T5 in Beverly's name because Beverly is the primary account holder. You're now going to do tax returns for Beverly and possibly for Carla. And I have a question for you, and I'm going to make that a poll. Okay, so on whose return should the interest be reported? Pick the statement that is correct. So statement 1, on Beverly's return because the T5 is in her name. Statement 2, on Beverly's return because most of the money in the account is hers. Statement 3, on Carla's return because the recent contributions to the account were hers. Or D, on both returns in proportion depending on the original amount in the account and the amount of Carla's contributions. So what do you think is the correct answer for this case? I like to pick things that come from real-world scenarios. Of course, names and details have been changed to protect privacy, but I think it is good to have some, when does this come up and when do you have to think about it? Why are you nagging me about a particular rule that I think I'm never going to see? So I can tell you that this is based on a real client. Okay, I've got about half of you have answered me and half of you are still thinking about it. Okay, still waiting for a few more people. You've learned about interest, you've learned about joint accounts. Let's apply that knowledge. Okay, still waiting for a few more people. Not seeing any more movement there, so let's just close the poll and see what answers we came up with. Almost everyone said D. D is the correct answer. It does not matter whose name is on the account. It matters who put the money in. It doesn't matter who put most of the money in. It matters what is the proportion. So I would now, at this point, need to say, all right, let's find out how much money was in the account before Carla put money into it. Remember, Carla has now probably put about $12,000 in, so that's a significant amount. We're going to see what the proportion realistically is, and we're going to split out the interest from the T5, put some of it on Beverly's return and some of it on Carla's return. So from a real world perspective, this is something we need to be doing. We only know to do this because we asked. If we don't ask, it doesn't happen. If I just got a T5 with Beverly and I put all that income on her return, it would affect her taxes. And if they eventually, anyone audits Carla and they look into Carla's situation and ask where her money's going, they're going to find that there's a joint account that she didn't report any interest from, and they're going to say what's going on there. And Helene, do they still do accounts with right of survivorship joint? That is a thing that exists. In Canada, there are special rules from the bank's perspective of what happens if someone dies while they are holding a joint account with someone else. We don't need to worry about that so much for that. And Brittany, if Carla isn't getting the interest, why would she report it as income? Well, the reality is she is getting it as interest because she is supporting her mom, and the interest is helping her to support her mom. She might, in this case, depending on the scenario, be getting a tax credit for helping her mom, which we're going to learn about later. So in that sense, when you have a joint account, it is all your money. And of course, if Carla was a horrible person, Carla could take all the money from the bank account and run. So the money is hers as much as it is Beverly's as soon as the account is joint. So for many, many reasons, it's her income as well as Beverly's income. So we have to factor it in according to the rules set out by the CRA, and this is what the CRA expects us to do. Okay? It would be nice to think that no one ever opens joint accounts with their parents and then drains all their retirement funds and leaves, but of course, that is something that can happen. So when you have a joint account, you both have equal rights to the money in that account, including equal rights to the interest. In terms of knowing how much to put on each tax return, the CRA needs an answer. The CRA could pick any answer they want. They could just say all joint accounts are 50-50. They haven't done that. What the CRA's rule is, joint accounts, look at the percentage of the money going in. That's where we want you to put the interest. So we have to follow the rules and basically do what they're telling us to do. All right, I want to talk about a special type of interest now. It's interest from a treasury bill. Treasury bills are not as common now as they would have been in the past, but they are things that you can buy. You usually buy them if you have a lot of money. So you need a big chunk of money. You put a big chunk of money down. 90 days later, you get a guaranteed larger amount of money. If you have a client who has invested in a treasury bill, they will get what's called a T5008. So a T5008 slip with certain things on it. This slip is actually used for more than treasury bills. It's used for all kinds of investments. If it's a treasury bill, you're going to see that the DOB, the type of security is DOB. DOB stands for debt obligations in bearer form. You don't need to know that. You just need to recognize that DOB is the thing you're looking for. Okay. Other things you might see under type of security will be SHS, which means shares, or MFT, which is mutual funds. We're not going to cover that much about shares and mutual funds in this course because it can get complicated. There can be some special rules when you're dealing with shares and sales of shares, especially people who are buying and selling frequently. So we don't cover that in this course. But most of the time with a treasury bill, if you put money in, you wait until it matures, you wait for the entire time that you're supposed to, and then you get your money back. If that happens, it's pretty straightforward, and you can handle that on a tax return, so we're going to teach you that. If you did this, what you get at the end is interest. So you put the money in now, 90 days later, you get your money back plus interest. How much it is the proceeds minus the cost. So proceeds minus cost, box 21 minus box 20, the difference is interest, and it goes on the tax return as interest. You have to be careful about one thing. This is what the slip would look like. It will say treasury bill on it somewhere. It will say DOB on it somewhere. You have to check before you do it to make sure box 19 and box 21 match, okay? If they match, if they're both the face amount and the proceeds match, it means that they left the money in for the full 90 days or however long the maturity period was. In that case, go ahead, calculate the interest, put it on the return. If the face amount is more than the proceeds, it means they sold it early, and then you can't do that tax return. You need to know a whole bunch of special rules for the calculation when it was sold early. So what I will say, if you see a T5008, check to make sure it says DOB. Check box 19 and 21. They have to match. If they match, you're going to take 21, subtract 20, put that as interest, and it's all taxable. Any questions about treasury bills? Okay, so you will probably see other things on a T5008 slip. If everything is filled out completely and it isn't an unusual scenario, they've just sold shares once, in that case, you will be able to handle it on a return. Most sales of shares are not interest, it's capital gains. So if it's sales of shares, sales of mutual funds, you'll have capital gains. If you end up working in an office, people will help you with the first few that you get. But it is important to know we're not going to cover it in this course, because once we get into sales of shares, it can get tricky, especially if people are buying and selling frequently. If they're buying and selling frequently, we have a whole set of rules for dealing with that. In that case, you're going to go find a more experienced associate to help you with capital gains issues. Treasury bills, however, you can do. All right, and then very briefly, foreign investment income. Sometimes you'll get foreign investment income from a tax slip, so you'll get a T5 or a T3, box 15 or box 25. Sometimes you'll get dividends for a foreign corporation. If you do, convert it to Canadian. You might get interest or other investment income from foreign sources. If you do, convert it to Canadian. So bank interest for an American bank, bank interest from a British bank, wherever that is, convert to Canadian, put it on the tax return. What else do we have to think about when we're thinking about foreign investments? Going all the way back to Chapter 2, if you have foreign investments, you probably have foreign assets. Check to see if those assets are over $100,000. Make sure you're filing a T1135. And remember, if there's income on a T1135, whether it's income from the investment, dividends or interest, or if it's property rent, or capital gains because they sold shares or they sold a property, remember that all of that income does need to end up on the tax return as well. So if you are preparing a T1135 for your client and you have income on that T1135, make sure you're finding the right place on the tax return to put it. Yeah, Brittany, I think the problem with tax returns is that they're complicated and everyone's life is complicated. So a simple return has a lot on it. I do promise you that we're just getting started on the practice. The more of them you do, the more comfortable you're going to get, which is why we're giving you so much homework and you have so many exercises and so many chapter review problems. The rest of what I add is going to be filling in pieces here and there. By the end of this course, you will have done a lot of tax returns, and hopefully when we get you there, you'll have done them on paper, you'll have done them on the computer, and it's going to start to feel like you have a handle on it. It's like any new skill. Riding a bike, you have to fall off the bike a few times before you learn how to do it the right way. So I'm told. I haven't actually learned how to ride a bike yet. All right, so foreign investment income, think about your T1135s. I'm not going to spend more review on it. If you need more review, You still have a practice question that I sent to everyone if you want to do it. And you can go back to Chapter 2 and rewatch that recording where we practiced T1135 in great detail. So yes, remember if you have assets outside the country, T1135. Okay. Where all of that goes, just reminding you, we're talking now not about dividends, we're talking about interest and other investment income. There will be a place for all of it. So royalties from investment rather than from things that you invented are going to go on line 8. Interest from bank accounts, all of those other things. Treasury bill interest on line 7. Foreign income on line 6. CRA tax refund income on line 5. And then all of your slip income is going to go on lines 1, 2, and 3. Add it all together, and you're going to get a number at box 11. We don't really have to worry about line 10 for this course because that deals with reserves and other things like that that we're not going to touch on. So we're just adding income in this course. Add it all. Make sure you haven't missed any. Put it on box line 11. Put it on line 12100 of the return. Okay, we've done dividends. We've done interest and other investment income. It says take a short break, but we did that already. I want to talk about capital gains next. So interest income, all of the income we're seeing now, dividend income is taxed at 100%, but you get a refundable tax credit for it. Interest investment income is taxed at 100%, and you don't get any credits for it. Capital gains, remember, is what happens when you sell your assets. If you don't own your assets anymore, we have a special rule, which is that capital gains right now in Canada are taxed at 50%. So because they're taxed at a different rate, we put them on a different form. The form we use is Schedule 3. Most of Schedule 3 we're not going to do. So most of the lines on a Schedule 3 we're going to ignore. We're only going to put 2 things on a Schedule 3 in this course, and that is anything that's reported on a slip because it's already been calculated for us. So if it's on a slip, it goes on the Schedule 3 where it says to go. And we're going to do principal residence. Principal residence has to go on a Schedule 3 as well. Other than that, if you have things that need to go on a specific line on a Schedule 3, you have 2 more courses that you can take before you get to that point. So I'm going to look very briefly now at a Schedule 3, going back to my tax return, opening up a Schedule 3 from my tax return, and it's going to look like this. So we're going to skip every single line on here except for line 7, which we'll do for principal residence. And then we're going to go to the second page and we're going to say, what do we have on a slip? We have T5, T513, and T4PS. Any capital gains from those slips goes on line 14. Anything from a T3 that says capital gains, the box will say capital gains on it, so you know which box it is. We'll go on line 15. You're going to add it together. Comes down to the bottom. You're going to take 50%, and only 50% of it is taxable. That's what goes on to the tax return. Nice and straightforward. Okay. The most common slips we see are a T5 box 18, a T4 PS box 34, a T3 box 21. If you have shares or mutual funds and they're not complicated, you're going to have a box 21 and a box 20. 20 is the cost, it's what you bought for it. 21 is the proceeds, it's what you got when you sold it. Take 21, subtract 20, that's what you put on capital gains line from the T5008. Probably not going to do that in this course, again, because we can run into problems if you're buying and selling a lot in a year. But if it's reported on a slip, absolutely put it on your Schedule 3. Don't memorize the box numbers. There's too many box numbers to memorize, and they change. Just read the slip. So the slip itself, you'll have something, and you'll be, what does that box mean? And right next to the box number, it'll say capital gains. Is this capital gains? Schedule 3. All right, you enter them on those 2 lines, and 50% is taxable. Nice and easy. The tricky bit is the one major asset that people might sell, and that's their principal residence. So I'm going to spend a little bit of time talking about principal residence exemptions. If you've been listening to politics in the last couple of years, you might have heard a big upset where people were saying the Liberal Party is going to take away our principal residence exemption. We don't like that. They're not going to. No one is going to take this away for a long time. People really like it in Canada. This is not true for every country, but in Canada, if you sell the home you live in and you make a profit on it, you don't have to pay tax on that profit. The rules for this used to be different. It used to be possible for everyone to have their own principal residence, which meant in a married couple, they might own 2 homes and they would get an exemption for both of them. That changed. I think it changed in the 90s. Might have been before that. I can't remember now. But it did change at one point, and the rule is now that every family, so every married couple, gets 1 principal residence. So even if you own multiple properties, you're going to have to pick which property is your principal residence. And for that 1 home, when you sell that home, you do not have to pay tax on the capital gain, so 50% tax on that. Okay. We're only going to deal in this course for a residence that has been your home the entire year. So we're not going to talk about what to do if you had a home that you lived in and then part of the time that you own that home you rented it and made money on it and then you moved back into it. That's way too complicated for this course. We're going to talk about people who have a home, live in their home, sell their home, and buy another home. That's what we're going to do here. If it gets more complicated than that, go get someone who wants to do all the really messy, difficult rules for other things, okay? It is important because in the past, you did not have to report your principal residence when you sold it on a tax return. So up until 2016, people just sold their homes and they went on with their life and nothing happened on their taxes. Starting in 2016, they have now made it mandatory that you report the sale of your principal residence even though it's not taxable. Does anyone know why they started doing that? Why did they start saying principal residence, everyone has to report the sale, even though the answer on the tax return is still 0? What is the government trying to find? Think about people who fix up houses and then flip them for more money. They're looking for people who flip. So if you are a house flipper, the home that you are currently living in is not your principal residence, it is your business asset. So if you buy a home and you move into it for 6 months while you renovate it, and then you sell it at a large profit, and then you buy a home and you move into it, and you fix it up while you're living in it, and you sell it at a huge profit, all of those homes you're buying are not your principal residences. They are the inventory of your business, and you should be paying 100% tax on the gain. Not 50% tax, not 0% tax, 100%. The way they're catching it is looking for people reporting the disposition of principal residences. And if you dispose of 4 principal residences in a year, the CRA is going to knock on your door and go, are you sure that those were your principal residences and not the assets of your house flipping business? So that's really the reason they're looking for this. It is important because if we don't put it on the return, then it is not exempt. If you don't ask for the exemption in the year you sell your home, then you have to pay tax on the gain. So think about a client who maybe bought a property somewhere in the city of Toronto in the 70s or the 80s, and they sell their house now. If they don't put it on the return, how much tax will they have to pay? Thinking about what's happened to property values in the city of Toronto, they may have bought a house for $80,000 and sold it for $2 million. 50% of that would be taxable if you don't ask for the exemption. So, very important question to ask your clients every single year. Did you sell a home? Did you sell the home you were living in? Because if you sold the home you were living in, you want to put it on the return. The government gave everyone 1 year between 2016 and 2017 to adapt to the new rules, and they said, we'll be nice for 1 year if you forgot, and after that, you should know better. Everyone should be reporting the sale of principal residences. So they are not allowing the exemptions. Now, it is an election, You can file a request to make a late election, but there's a penalty for doing it, and the government doesn't have to say yes. So best case scenario, if you forgot this, you're paying at least an $8,000 penalty. Worst case scenario, you're still paying tax on all of it. So probably the most expensive mistake you could make on a tax return is not asking for this. It will not be allowed if you don't ask for it. Oh, Marisa, you did real estate in a law firm for 20 years and you didn't know this. It's surprising how many people don't know this, considering the fact that it's been around for a while now. So we as tax professionals need to know this rule. We need to be saying, you sold the home you lived in, we have to put that on your tax return. How we put it on the tax return we're going to talk about, and what a principal residence is we're going to talk about. So let's talk about a principal residence. First of all, it has to be a home that you can live in. So just like first-time homebuyer amount, this isn't going to count if it's a home that doesn't have plumbing and electricity, because it's not a home you can live in. If you have a building and a property, you can't just call it your principal residence. You actually have to have a place you can live in. Okay? You have to own it. So whoever owns it has to report the sale when they sell it. You might own the property together. So when you own property in Canada, most places in Canada, you can own it jointly or tenants in common. Tenants in common means you each own a specific share. So I own 40%, they own 60%, I own 50, the other person owns 50, whatever that is. In that case, it's easy because when you sell it, you sell your share of it. Joint tenancy is trickier. Joint tenancy is very common, especially between spouses. Two people will buy the house together, and both of them own 100% of the house. And if one of them dies, the other person still owns 100% of the house. So it doesn't have to go into the estate. That's why we have joint tenancy. It causes problems for principal residence definition because we don't want to double report the value of your home. So if you have joint tenants, for the purpose of this form, you're going to split evenly. So joint tenants, if it's two people, you'll split it 50-50. If it's three people, you'll do 33% each. And that's what you report when you sell it on your T2091. Okay, so you're always going to do a share if it's owned by multiple people. To be a principal residence, it must be ordinarily inhabited by you, your spouse, your former spouse, or your child. Okay, ordinarily inhabited is pretty vague. You don't have to be there every day of the year. You don't even have to be there most of the year. It just has to be a place that sometimes you are living in the year. Okay, and the property doesn't have to be in Canada. There are special rules for people who are coming into Canada to determine the value of their home at that time, to make sure that they're not having to pay large amounts on the gain while they're here. When they leave Canada, they may have to do an adjustment at that point. So we're not going to do immigrants and immigrants in this course. But if you know someone who's coming into Canada and they own a property somewhere else, or they're leaving Canada and they own a property somewhere else, if they're renting here, there are rules that they may be able to use for part of the time having gains to that property being exempt. Okay. Leon, if someone changes the property principal residence after having owned it for some time, will it be exempt? It will be exempt from the time that you changed it. So we do have people who own two homes, or they might own a home and a cottage. You're going to have to pick one. Once you sell it, you make the decision which is going to be exempt, and you either pay tax on it or you don't. But if you've made that decision, you can't then sell the other house and go, I changed my mind and I want this one to be exempt. You're only ever going to have one principal residence at a time in a year. We do run into the problem because you're only allowed one per year when you sell a home and you buy a home. So we have what's called a +1 rule. I'm going to show you on the form how that works. The +1 rule says that you will get principal residence for all the years you owned it, +1 rule as long as you're resident in Canada. Okay, and in that case, as long as you're in Canada, that way you can sell the home, designate the home you sold. Let's say I owned a home from 2015 until 2021. I can designate it from 2015 to 2020. The +1 rule will give me an extra year buffer, so it's exempt for the whole time. And then my new home, I start the clock in 2021, and when I sell it, I'm going to use that +1 buffer again. Okay. Helene, what if the home is owned by two people who are not related? That's fine because each of them can have a principal residence and it can be their principal residence. So each of them, when they sell, will declare their share of it as being their principal residence. Okay. So always looking from the taxpayer who's sitting in front of you. If they own one home and that's the home they live in, that will be their principal residence if they elect for it to be, which they will because you want it to be exempt so you don't have to pay tax on it. Okay. If you're going to designate a principal residence, and again, in this course, we're only going to do people who are going to make the home the only one they have because it gets complicated if you have more than one, and you should see a specialist for that. Okay. So if it's the one home you own, then you're going to, on the Schedule 3, enter the principal residence. I'm going to show you where that goes. Then you go to the bottom of your Schedule 3 and you tick box number 1. I designate the property described on Form T2091 to have been my principal residence for all years owned. Have to do that. If you don't tick the box, they don't know you're filing a T2091, you're not going to get the exemption. So when you're designating a home, you have multiple things you have to do, and I'm going to show you what they are right now. So the first thing you do is you go to your Schedule 3, and you say personal use property, describe the property, so give an address or a roll number, whatever it is, and then you're going to fill in these columns with zeros, and you're going to put a 0 here because none of it is relevant because it's exempt. Then you go to the bottom of the form, you tick the box principal residence designation number 1, then you fill out a T2091. Okay, I have a question here. If a person is selling their home in the city and they have a cottage, does the cottage become the principal residence even if they rent in the city? So they're probably in that year going to sell their home in the city as a principal residence. It'll be exempt for that year. If they don't buy a second home, the cottage can become from that year their principal residence as long as they at some point ordinarily inhabit it, which means as long as they're using that cottage on a reasonable enough basis that they can say that they are in it. Okay? And that means when they finally down the line sell that cottage, they'll have the option of claiming principal residence exemption for some of the years that they own the cottage, but not all of them because they had a principal residence first, which was the home in the city. That part of it, the cottage part of it, would be done by a specialist. Okay? So we're going to have a principal residence designation. We've sold the home we live in. Fill out Part 7, say principal residence exemption, put 0, tick the box. Now we need a form T2091, which I'm going to have to pull up, so I will search for that here. Remember, you can always search for your forms. It's the first one that's going to come up here, and I'm going to fill it in. If it will let me download it, there it is. When I'm filling in a T2091, I have to say the tax year in the top corner. It has to match the tax year I'm filing right now. I'm going to put the address in, province, postal code, city, country, year of acquisition. What year did you buy the home? And how much did you sell the home for? How much? Remember, if it's jointly owned, if it's owned 50-50, so if you own it with one other person, put half the proceeds on yours. They'll report half the proceeds on theirs. If you own it with two other people, you're going to split it evenly between you. Unless it's tenants in common, it's going to be the actual number that is your share. Okay. Then you have to say, I, the taxpayer, designate the property, and then we're going to deal with homes after 1981, but you might have a home after 1971 and before 1982. Capital gains rules changed and principal residence rules changed a couple of times between those years. For this course, we're going to do properties mostly after 1981 to make it easy for you. In real life, we'll show you how to do this in the computer as well. But we're going to say how many years. So let's say it was that 2015 that I bought it until this year. I'm going to say 2015, 2016, 2017, 2018, 2019, 2020. And I'm going to stop at 2020, and I'm going to do 6 years. So 2021 I want to save because 2021 I need for the new home that I bought. If I bought a new home. If I'm renting now, then you're just going to do all the years. But if I sold a home and bought a home, save 1 year back, so I would do 6 years here, and then it says, I confirm that neither I nor my spouse was had any other property designated, and then you're going to sign it, put your social insurance number, date, and you'll notice that the +1 rule for capital gains will cover you. So the rest of it you don't need to do. The rest of the form is the more complicated section, so we don't need that. As the date of exchange or completion, it's the date of completion usually, okay, but it doesn't really matter in this case. That's really only an issue if it's across a year. So, when did you stop being the owner of the house, essentially, is the date we're looking for. If it's close enough, they'll take it because it's principal residence exemption and it won't change anything. They want to make sure you are reporting it. Okay. When you have all of that, you are done. You've done the principal residence correctly, and you can confidently go forward and not worry that you are causing a lot of possible tax money for your client. Practice this. We will practice them together, and we'll practice it when we get into the computer part of things as well. What happens if you don't claim the sale? If you don't claim the sale and the government finds out that there was a sale, which they might do in a number of different ways, then they will go back in and ask you to tell them what you bought it for and what you sold it for, and they will add it in as unreported income, capital gain. If you don't do the principal residence exemption, if you don't elect it, 50% of the gain on your property, if you had a gain, if you sold it for profit, will be taxable. Again, that might not matter. Maybe you lost money when you sold the property. But a lot of times, especially for the clients who've owned a property for a number of years, what we've seen in the markets is usually they make, some money, and you don't want it to be taxable if it doesn't have to be. So very important, remember to ask about principal residence, and if they had a principal residence and they sold it, make sure that you do a Schedule 3, fill out Part 7, fill out the box at the bottom that says all years, the one you're looking at the screen right now that says T2091, and fill out a T2091. Do that every time. You can have a client who is not a house flipper who will have 2 sales in a year. That does happen. In that case, you're going to be doing this twice. Okay? So we did have a client in Toronto who bought a home, fully intended it to be their forever home, moved in with their kids, the whole deal, and then someone came by, a developer or something, with an offer that they could not refuse. It was just too much money. And they were like, we're never going to see this again. We love this house, but we don't love the house that much. And they sold that home and bought another one. So they had 2 sales of a principal residence in the same year, and they're not house flippers. And that's fine. They're both valid. But they did have to do 2, and we did warn them that there was a good chance that they were going to be asked about that. And that was fine because the new house that they had was the house they stayed in after that, and they're clearly not house flippers. But remember, if you have a client who has, a new house every single year or a new house every 6 months, probably they're not principal residences, and you should be warning them that they're going to get audited. And having that audit is going to be really bad because house flippers, again, it's not capital gains for house flippers, 50%. It's income, 100% taxable for the gain. So that's one where if you do notice that your client has been filling out an awful lot of these, probably have a conversation and say, I'm not really confident that these are your principal residences. I think you're in the business of flipping homes and you should speak to a specialist. Okay, principal residence done. Attribution rules. This is the last difficult thing we're going to do today, and I want to talk about it. There are rules in place to prevent people from quote unquote giving money to their family members in order to avoid paying higher taxes on it. So if you are giving money or assets to a family member, there are rules that say what happens to the income and who has to report the income on their return. Okay? It only applies to the property itself. So income from the property itself stays, But if you make more money off of that, then it breaks the chain, and I'm going to demonstrate what that means. There's two sets of rules, one for giving money to your spouse, common law or married, and one to giving money to your minor children. Okay? After that, no attribution rules. And the two rules are different, so we need to look at them. If you give money to your spouse from the time you are spouses and for as long as you are spouses, so the relationship has to be there the whole time, in that case, any capital gains from that transfer, any interest and dividend income, all the different sources of income belong to you. Again, think of the case where you have two married people, one has really high income, the other has really low income. It would be really nice if the high income person could just put all their assets in the name of the other person, and then all of a sudden all that income is being taxed at a very low rate instead of taxed at a very high rate. People tried it, the government caught them and said, we have a rule for that now. This attribution rule happens until the breakdown of the relationship or until a person dies, because you can't be married after a person dies. So we need to know the dates of the marriage and how long they lasted and when the transfer happened. But as long as that transfer exists while the marriage exists, you have to use the attribution rules. Okay? I'm going to give you examples. I want to talk about minor children next. If you put assets in a minor child who is your child, grandchild, brother, sister, niece, or nephew, that means under 18 and related to you. We'll talk about what a child related to you is later. So for now, use what you know of it, and then we're going to make it more complicated later, because that's what I do in this course. Child, grandchild, brother, sister, niece, or nephew, and they're under 18, if you give them money or you give them assets, mostly we're talking about assets here, then the income from that will be attributed back to you if it's interest and dividends, but it will not be attributed back to you if it's capital gains. Okay, so interest and dividends, yes. Capital gains, no. The only one is if Canada Child Benefits. If you get Canada Child Benefits from the government for your child and you put it in a bank account in the name of your child, that is not your money that you're giving the child. It's the child's money that you're giving. So that one circumstance, you don't have to worry about attribution rules for the interest from that account. But it has to be an account just for the child. It has to be separate. It can't be a mixed account where some of it's your money and some of it's theirs. If you're mixing it, if that CCB money is going into an account with other income in it as well, in that case, the attribution rule still applies. Brittany, so you can't actually just give your child a gift, a true gift, where in all legal sense it belongs to them. Not if the gift that you give them incurs money or incurs income. The income remains yours until they become 18. Once they're 18, you can give them whatever you want because they can do whatever they want with it. And again, this is because they closed the loophole on spouses, so people started putting money in their children's names instead of in their spouses' names to try to avoid paying tax. Gifting to parents is allowed. So these are only for child, grandchild, brother, niece, or nephew. You can gift to your aunts and your uncles, even if your aunt and your uncle is under 18. That can happen. And that's because we need a rule, and the rule needs to make sense, and this is as good as we can get. So if it's on the list, child, grandchild, brother, sister, niece, or nephew, we have to think about attribution rules until that child turns 18. So let's practice. Sarah transferred $2,000 worth of shares to her girlfriend Muriel in January of 2021. Muriel and Sarah then got married in June of 2021. The shares earned dividends. Dividends happen on specific dates. Okay? February 1st, May 1st, August 1st, and November 1st, $25 on each of those dates. And then Muriel sold the shares in December for capital gain of $200. And finally, Muriel took all the dividends and income that she got and put it in an investment account and earned $5 in interest. So we're going to talk about the attribution rules for each of those things. Okay? So let's talk about the shares first. How much do we have to attribute back to Sarah, and how much dividend income will show up on Muriel's return? let's talk about the date of marriage. They got married in June 1st. So in February, did Muriel have assets that were given to her from her spouse? No, because she didn't have a spouse in February. So we won't do any attribution in February. So the dividend income in February belongs to Muriel. Then we get to May. They're still not married. So the dividend income belongs to Muriel. Now we hit August. What happens in August? By August, Muriel has assets that were transferred to her by her spouse. So even though the transfer happened before they got married, now they're married. So now we have to attribute $25 dividend income to Sarah. So Sarah is going to claim $25 of dividend from August. November, they're still married. So Sarah is going to transfer $25 of dividends, or Muriel is going to have to report it on that. And even if the gift was given for their spouses, yes, because do you know why? Because as soon as they close the loophole that says you can't give a large gift to your spouse while you're married, then everyone who wanted to hide assets gave all their stuff to their spouses before they got married as a pre-wedding gift. And all of a sudden, then they were not paying tax again. So every time someone did something, the CRA made a loophole, said that's a loophole, we didn't intend that, we're closing it. So as long as they're married, the attribution rules will continue until they stop being married. Okay, so hopefully you can see in this case, we have $50 of dividends being reported by Muriel, $50 of dividends being reported by Sarah. What happens to the capital gain? They are spouses. Who reports the capital gain while they're spouses? Doesn't matter who has the higher income, and we don't get to pick. What does the attribution rule say? The money is attributed to the person who gave the gift. Because they're married, capital gains get attributed back to Sarah. So Sarah must report the capital gain even though she doesn't own the shares. So in this return, we're going to have $50 of dividend income for each of them, $200 capital gain taxed at 50% on Sarah's return. What about the interest? So Muriel took her dividends, put it in an investment account, and earned $5 of interest. Who reports the interest? Whose interest is it? Muriel's. So that's where we've broken the chain. Muriel can do whatever she wants with that money. She is responsible for what she does with that money. She could have bought a lottery ticket. She could have bought a really expensive purse. She invested it. The investment income is hers. There you go. You have example number 1. Let's try another one. We have James and Olivia. James and Olivia have been married for 10 years. While they were married, Olivia transferred some shares to James. Unfortunately, their marriage broke down, and they separated on September 10th of this year. So now we have to think about attribution rules, when they start, when they stop. Okay, the shares earn dividends in the amount of $75 on the following dates. We have June 15th and we have December 15th. And I know that James, after the marriage broke down, decided to sell the shares, and he had a capital gain of $4,000. So I'm going to do a little poll here, and I would like for you to tell me, oh, where did my polls go? I'd like for you to tell me who will report the dividends, how much, and who will report the gains and how much, and you're going to pick all of the ones that apply. Okay, so we have James will report 150 of dividends on his tax return. Olivia will report 150 of dividends on her tax return. James and Olivia will each report $75 of dividends on their tax returns. We have James report 4,000 capital gain, Olivia will report 4,000 capital gain, or James and Olivia will each report 2,000 capital gain. Okay, so out of those, you should pick 2 answers, and let's see if you can get this right. Think about what happens and when it happens in relation to the marriage. So I like to draw a little mental timeline in my head that says, we're married, we're married, we're married, we're married. Oh, a thing happened. What do I do with the income? Okay, we're married, we're married, we're married, married. Oh, we got divorced. Then we're divorced, we're divorced, we're divorced, we're divorced, we're separated. So separated, separated, separated. Then a thing happened. Separated, separated, separated. A thing happened. What do I do? That's how I think about it. Let's see if that works for you. Okay, I know this is a trickier one, so I did give you a bit more time. You've got about 45 seconds to lock your answers in. Okay, 12 seconds left, 10 seconds left. Hit the submit button if you think you've got your answer. Make sure it gets registered. Even if you're not sure you got them all, lock it in. And let's see how we did. And Brittany has a question. If someone gives their spouse shares and the spouse already owns the shares in the same company, can they put the gift in their portfolio or must be kept separate? They can put in their portfolio. For the tax return, we need to know how much is which. So we do have to know how much was transferred versus how much was originally theirs, and then report the income accordingly. All right, let's see how we did. I think you guys did pretty well. So overall, you noticed that they're going to split the dividends because the first dividend happened while they were married. So the first dividend belongs to Olivia. The second dividend happened after they were separated. So the second dividend belongs to James. And then the capital gain belongs to James because they were separated and it's his. So after they separated, it's still his. And we don't attribute it back because they're not married. So the correct answers were James and Olivia will each report $75 of dividend income, and then James will report the full capital gains. And Brittany, what if they get remarried? Like I said, life gets complicated. If they get remarried and it's still something that was hers, theoretically the attribution starts again. I will say I haven't had to do that one in real life. So it's not super, super common that this is something you're going to deal with all the time, but you do have to ask about it. And I definitely have had people who have created all kinds of scenarios by separating and remarrying and separating and remarrying and having common law spouses. We'll talk about some of those clients when we get to the complicated family chapter. Okay, but the rule is if it is a transfer from a spouse, doesn't matter when the transfer happened. The fact is you are a spouse, you got it from them, attribution rules apply. All right, we have more information about James and Olivia. While they were married, she transferred $10,000 into a TD bank account in his name, not a joint account, only his name. He's the only person who's going to get a tax slip for it. Their marriage broke down. They separated on September 10th. James now has a T5 slip with interest income. How much interest will be reported on each return? Well, for this one, we have to do some math. So, how many days in the year were they married? If you like, there are some really nice free online calculators. You can Google how many days are there between January 1st and September 10th, because they were together for roughly that many days. What we have to do in this case is figure out how many days the interest is attributed to Olivia, and the rest of it goes on James's return. This is definitely a real-world scenario that you will have to deal with when people separate. I actually had a really fun couple where they both owned a business together, and all the investing had been done in one person's name, but it was meant to be jointly owned. And when they separated, there was a really big, messy separating everything out and who gets what and what happens to the property and what happens to the business. And we had to sort out all of that stuff plus attribution rules for that year. So that was a really fun tax return to do. All right, so if you've done the math by now, you should know that there are 252 days between January 1st and September 10th. And Brittany, if it isn't a joint account, it doesn't matter that James owns the money because they're married, so the attribution rules apply. That is the whole point of the attribution rules, is that they apply even if you don't own the asset. Because people do this to avoid paying tax. And the government says you're not allowed to avoid paying tax, so they have the rule. So we have a T5 slip for James. We have to portion it out. We're going to say 52 days. So I'm going to take $115, multiply by 252, divide by 365, and I get $79.39 belong to Olivia. Olivia has to report $79.39 of income on her return for interest. And the remainder, $35.61, is James's interest. Next year, it will all be James's interest. But for the period they were married, the attribution rule applies. All right, let's do another one. We have Edward. For Christmas in 2020, Edward transferred 100 shares of stock and $5,000 of accounts into his niece's names. Okay, Mary was 16 in 2021. Margaret turned 18 on July 1st, 2021. We have some shares. We have some sale of some shares. And we have some interest from the bank account. We're going to deal with all of it. So let's start with the first one. I'm going to do some annotation here. You guys can help me out with this and tell me what to put in the boxes. Okay, I think I'm going to try blue. I think you'll be able to see blue if I write in blue. Type of income, let's start with dividends. Okay. How much dividend income will Mary report on her return, knowing that we have attribution rules because Edward gave it to his niece Mary, who is under 18? How much dividend income will Mary report? What do you think? You can add it in the annotation if you want to, or you can tell me in the chat window and I'll type it in for you. None, because she got the money, but she's a minor. It will be attributed back to Edward. Good. What about Margaret? She got $25 on each of them. So February, not her money, not hers according to the tax return. May, not hers according to the tax return. August, now she's 18 and she can do whatever she wants. She gets 25. November, she gets 25. So everyone who said 50, you are correct. What about Edward? How much dividend income does he have to report even though he doesn't own the shares? What do we think? 150, which is all of Margaret's, no, half of Margaret's and all of Mary's. Excellent. Good. Let's try another one. What about the capital gains? So I'm going to say here, capital gains. Who reports the dividend income, or no, who reports capital gains income when you are attributing between a minor and a relative? Spouses, attribution rules. Capital gains belong to the child. So Mary will have $50 of capital gains divided by 2, 50% will be taxable. Margaret will have capital gains. Edward will not have capital gains because the attribution rules between a child and a minor are different than between a spouse. And the T5s, I'm going to skip that one for now. I will tell you for the T5s, all of the interest from Mary belongs to Edward. Roughly half of it, because of her birth date, is going to be Margaret's, and the remainder will be Edward's. And I'm going to do one more poll, which is one just to see if you've thought about when you need to file a tax return versus when you want to file a tax return really, really quickly. Does Edward have to file a return, or do we not know? Maybe he does, maybe he doesn't. Does Mary have to file a tax return? Do we not know? Maybe she does, maybe she doesn't. Maybe she's too young. Does Margaret have to file a return, or does she maybe want to or maybe not want to? Let's see if you can get that one right. I've given you some time. Go right back to chapter 1. Think about when you need to file a tax return versus when you want to file a tax return. So wanting to means because we want benefits. Needing to means we have no choice. Let's see how we do on this one. And Leon, I see your question. I'm going to answer because it's a very good one. I'm just going to give people time to think about the poll first. So for the poll, I want an answer for Edward, an answer for Margaret, and an answer for Mary. Let's see what we think. Okay, I'm going to give you all about 30 more seconds, and then I'm going to end the poll because we have to answer it, and I don't want to go too much over class today. Okay, if you've picked your answers, lock them in, hit the submit button. All right, I'm going to stop the poll there just so that we can get the answer. We'll go through the poll, then I'm going to answer Leon's question. And then I'm going to do one more thing, and then we're done for today. So we're going to go probably about 5 minutes over. But I want to make sure you have all this before you do your assignment. So the answer is we don't know about Edward. He might want to, he might not want to. There's nothing that I can see that says he must. He has no capital gains to report. Capital gains mean you must. We don't know if he's going to owe or if he's going to get benefits, so he might want to, but nothing tells us that he has to. So the correct answer for this one is B. Edward might want to, he might not want to. We don't have enough information to answer that. Margaret must, because Margaret has capital gains. If you have capital gains, you must file a tax return. Margaret has no choice. Mary also has to file because Mary has capital gains and she needs to report the disposition of an asset. Even though she's 16, she must file a tax return this year. So going back to chapter 1, I will say I'm very proud nobody said Mary was too young. You have learned that there's no minimum age. You forgot that if you're putting capital gains, you must file a tax return in the year. So be careful. There's a little test of your knowledge. Good. Got one more thing we're going to do really quickly, which is carrying charges. Carrying charges is the deduction you get from the cost of investing. We have to be careful because a lot of things that you will spend when you are investing do not count as carrying charges. The only things that do are investment management fees. They are specific to the fact that you are investing, and you will usually see them reported on a slip as investment management fees. If they're on a slip, you can claim them. Accounting fees for maintaining investment records, including the preparation of investment-related tax forms, but you can't include the full tax prep fee. Most places don't give you a breakdown, which means you can't do it. And it really only counts if you have very complicated, very specific investments. The average person is not going to be able to claim their accounting fees. Investment counsel fees means you are paying someone specifically to give you advice for your investment. Okay. You can claim interest. We'll talk about interest as well. The tricky thing for carrying charges is it has to be fees to you personally for the investment. that you are making, not fees that you pay for mutual funds. So you know when you're investing in a fund, mutual funds, or you have an investment account with a bank, you're paying management fees in those, but most of those management fees don't qualify because they're not giving you specific advice for your assets. They're giving advice to manage the entire fund for lots and lots of people. So those fees do not count. Most of our clients don't have the kind of assets where they actually pay very specific investment management fees. So for the purposes of this course, if it's on a slip, yes, but for real life, it is rare that you will have investment management fees that qualify. If you want to know more about it, I will send some information. I'm going to send you a publication through the email at some point. There is a bulletin. I'm going to type it in here called IT238R2. You can look that up on the CRA if you want to. It's a very old, very dry publication, but it sets out what counts as investment management fees and what doesn't. So for your own personal knowledge, not necessary for the course, but in real life, that's a very helpful bulletin to decide if the fees that someone's bringing me count or not. Okay, so broker's fees related to the purchase of stocks are not allowed as carrying charges. Getting advice, so going and getting a subscription to an investment newsletter does not count. So those things don't count. These are all called carrying charges. The other one you're going to hear about is safety deposit boxes. People used to be able to claim safety deposit boxes because they had to put their share certificates somewhere. Those are no longer allowed, so that's not a carrying charge. The other one you can claim is interest expenses. If you borrow money to invest and you use that money to purchase investments, yes, you can claim the interest as an interest expense, and it goes on the same line as the carrying charges. Put it on the worksheet on the bottom, but not if you're investing in RRSPs. If you're investing in registered funds, then you can't claim the interest. It's only if you're investing in non-registered funds, stocks, mutual funds, bonds, GICs, treasury bills, things like that, yes, but if it's a registered fund, if it has an R in front of it, no. Okay? So those are those rules. That's everything you need. Helene, why can't you claim the investment newsletter? Because it's not personal to your accounts. So when they're talking about carrying charges, they're talking about things that you are paying out of your own pocket for your personalized, specialized advice. Not general knowledge and things that anyone can access if they want to access it. And it's mostly because the government can pick what they want to give you a deduction for and what they don't. All right, that's it for class today. If you have to go, that's fine. If you have questions about review problem 7.2, I will let you know if we get it on the recording. So if it gets on the recording, once it's posted, I'll send out a message that it's posted. In the meantime, if you have questions about the answer, send me your review problem, and I will check your answer for you. And then going back to the attribution rules, Leon had a very good question. If the gift was transferred into a current account and over the following years put towards other things, you don't have to track it. Remember, the attribution rule stops when you take the next step. So if you take the money from your bank account and you do something else with it, once you do something else with it, the attribution is broken. It's only the original asset that is tracked. And this is to stop people from putting money in someone else's name and pretending that it's not theirs so that they can pay less tax. But once that person takes the asset and does something else with it, we no longer have to track the next step of the process. Okay, so that hopefully will simplify for you a little bit. Okay, final review problem, chapter 7-2. I'm not doing review problem 7-1 because it is your assignment, so you have to do that one. We will take it up in class when we get to it. But let's go through 7-2 together. We have Mary Murray. Mary's divorced. We have an address. Mary works as a legal secretary. She worked remotely and she worked from home. And I'm going to tell you that she worked full-time all year, and we're going to use the flat rate method. Remember, in real life, probably didn't work 250 days from home. Check about vacations and stat holidays and things, but I will tell you, Mary did work 250 days from home. She's a very hard worker. She also decided to invest. So to make wise investment decisions, she subscribed to a newsletter. Can we claim the newsletter subscription as a carrying charge? No. Specifically no, the Income Tax Act says no. She had a Canada Savings Bond that matured, that's interest, so we have a slip for that. She then took all the money out of her bond, borrowed another $5,000, and bought some stocks. Can she claim the interest from her loan as an interest expense? She bought stocks? Yes. So we're going to make sure we have an interest expense for her. Okay, we know it was 180, so circle that 180, make sure that goes on. We have donations, 125 and 50. Okay, she's a Canadian citizen, owns no foreign property, wants to answer yes, doesn't want to register for online mail. I'm going to look at her tax slip and see what's there. We've got some pension, no union dues, no donations. Going down to her next slip, I'm going to have taxable amounts of eligible dividends that has to go on the return. Dividend credit is going to go on the return. I have capital gains. I have to do a Schedule 3. I have IMA fees. IMA fees on a slip? Yes. IMA fees, we have carrying charges on a slip. Circle that number. I have a T5 with a box 13. Interest. Interest income from a slip goes on the worksheet. Circle that number. I want that one to go on the worksheet as well. Okay. Can she claim expenses? Yes. We can claim working from home. We can claim IMA fees. We can claim the interest expense. Okay. Non-refundable credits we'll take a look at, and we'll talk about tax tips. Let's see what her return looks like. Okay, and I know I'm doing this very quickly, but the reason I'm doing this very quickly is because we have not very much time, and you have an assignment coming up. So, Mary Murray, I may come back to this again beginning of next class as well in more detail, but let's get the information out if you've done it. So, I'm going to assume you did the first page correctly. Make sure you've got province of residence as Manitoba and divorced. We're going to say yes and no. Income, employment income, $45,000. I'm going to stop right there. I have a lot of investment income. The very next thing I'm going to do is a worksheet. Let's look at the worksheet. I have Canadian dividends. Canadian dividends, box 32 and box 50 of the T3 slip goes in 409.58. There's my 409.58 gross up amount only. I'm not going to put the actual amount. That's going to go on line 12000 of my return, and I'm going to calculate a dividend tax credit as well, and I'm going to put the dividend credit from the slip on the dividend credit and on the provincial form. All right, then we're going to get down to interest. I have interest from a T5. T5 box 13 is going to go there, and that's going to go on as income. And then carrying charges, I'm going to have management fees of 85, investment loan of 180, total carrying charges of 265. I take all those numbers, I put them straight on the return. If you've done that, your income page is now going to look like this. We're going to have 1,200. There's your dividends. There's your interest. The next line I'm going to hit, capital gains. So I'm doing a Schedule 3. Schedule 3, we're not touching the first page in this case because we're not doing anything complicated. We're taking the number from the slip, but I will say put it in the right place. So if it's from a T3, put it on the T3 line. If it's from a T5, put it on the T5 line. Don't get them mixed up. It can accidentally double your income because if you say I have a T3 and the government sees a T5, they will helpfully add the same income back in again. So make sure this is on 17600. It's 250. Half of it is taxable, so I'm going to take 125 and I'm going to put it back on the return. Back to my income page, I have total income of $45,909. Deductions, I have RPP. I'm going to have carrying charges. We put those on already. CPP, I'm going to assume you can do your Schedule 8 by now. And other employment expenses, I need a T777S for that. I have a T77S. There it is, 250 times 2, $500. That's where I got that one from. Add them together, 1872.50. Net income 44,037.08. Taxable income is the same. Lowest tax bracket 15% federal tax. Tax credits, we get the personal amount. So they said, which tax credits does she get? She gets the basic personal amount. She gets CPP. She gets EI. She gets the Canada employment amount. And when we get to the bottom, we're going to do some donations for her. If we want to claim the donations, you need a Schedule 9. 2625 is what you get. Total credits 2700.11. And please don't forget dividend tax credit. So we also have a dividend tax credit, which we need to use the federal worksheet for. It's going to come straight from the tax slip. In this case, we don't have to calculate it. It's straight from the tax slip. That's going to bring her federal tax down to $384,393. I'm going to do some provincial things. Let's look at the Manitoba family tax benefit. She is not going to get that, but we did check. She's not going to get her personal credit, no refundable credit for her. Her income is too high. But she's in the second tax bracket here. She gets a basic personal amount provincially, CPP-EI, and then 10% of that, we're going to do the donations, $175. Don't forget the donations on the provincial. And don't forget the dividend tax credit. You need the worksheet for the dividend tax credit. I'm going to show you that one very quickly because you might not have practiced it. The worksheet is the amount from line 12,000 times 8%, 32.77. There's your worksheet. We're going to reduce her provincial tax all the way down to $3,534.21. Go to the last page of the return. Add those together. She should have paid $7,378.14. She did pay $7,730, and we're going to have a small refund of $351.88. This is the recorded version, so I know it's fast. I will also say, if you have questions and you want someone to look at your forms, send me yours, and I will correct them for you and help you see where you went wrong. So that was very, very fast. I'm going to ask one more question and then we're done today. What tax advice might you give to Mary? So there's two things that I can think of. One I'm expecting you to think about, and I'll give you a hint for that one. So here's my first one. What tax advice might you recommend that has to do with the Schedule 9? And the other one you might not think of, but we're going to start putting the idea in your head. It might improve her tax situation for next year. What could she do with her donations? She didn't have a lot of them. She's going to get 15%. What might she want to do? She might want to save them for next year. If she's going to donate another $175 next year, it's better off to save and claim them all together. Pool them together and get more. If that is what's going to happen for next year. If she knows that this is a one-time thing and she's never going to keep her receipts and she's going to lose everything, in that case, yeah, put it on now. But that's one thing she might think about. I'm going to ask you about the other one, and let's just see how we're thinking. So we have income on the return that is taxable. We have some dividends from investment, we have some interest from her investment, and we have some capital gains. Can anyone think of something that you can do if you're in Canada that can take income that's normally taxable and make it not taxable? Where could she put her money instead of in the investments she has now to take all of that off her tax return next year? Haven't really taught this, but I want to put the idea in your head so that when we get to the unit on it, you see how it works. RSP, no, because if she wants to access the RSP, she's going to have to pay tax on it. What can I do to make it not taxable at all? Tax-free savings account. TFSA. Most TFSAs will let you invest the same things inside them as you are investing outside of them. If she has room in her tax-free savings account, she should be filling that up first, because all of the interest, all of the dividends from her tax-free savings account, all of the income will be not taxable. It's better to have all of that money, that $375, the $125. The only one she might not be able to do is the Alpine. If possible, you want to take that off the tax return completely. That's better than putting it on the return and getting an investment expense or a deduction. So that might be something that we'd suggest to her for the future. All right, we've gone a few minutes over. Thank you for sticking with me. I'm going to say goodbye there.